Estee Lauder is 36% of the highs. Is it finally a buy now? Did I even pronounce that correctly? Hello, fellow investors. I'm screening household and personal products stocks. Last time I screened PG stock, this time it's EL, Estee Lauder. EL is a cosmetics company, a manufacturer of makeup, skincare, fragrance, and hair care products. This is EL stock valuation summary, mostly red, implying overvaluation. The only good metric here is the EPS multiple within my range of 3, 2.84, and historical PEs. But look at that lowest average historical PEs. It's 29.23. That's just too high. It's overvalued since it's trading at 2.52 times their margins. I used 10.3 here as the lowest margins to base our assumptions and fair values from. 10.3 is the 10-year average net income margin. I use 30% margin of safety here from the highest margin of 13.42, the 10-year average free cash flow margin. So for that, my entry PEs would be 8, 9, and 10. Again, if you guys didn't know, I pay $1 or less for 1% of their margins, meaning I pay 1 PE or less for 1% of their net income or free cash flow margins. Price to free cash flow is twice my allowable at 44.4. I have an allowable of only 20 price to free cash flow, historically overvalued, and PB ratio wise expensive at 13.74. I only have an allowable of 5 PB ratio. I'm screening it at the current price of $237.83. My fair value of the stock is $94.22. Intrinsic value from Guru Focus is $67.93. Here are my entry PEs and prices. I have a high price of $91.5 with a PE of 10. I don't own the stock. I don't think you should pay premium for the stock. Let's look more into the stock. They give out an annual dividend of $2.4 per share, a 1.01% yield of the current price. The stock is now down 36.44% of the highs. EPS is increasing, OSN is decreasing. They bought back 10 million shares in 5 years. Their margins play around 10 to 14%. I wouldn't count on these margins here just yet because I think this is an anomaly, at least compared to the previous years. I don't like seeing single digit growth. That's why I don't recommend paying premium for this stock. Price to free cash flow is super expensive right now. Payout ratio is low though, 26.23%. I think the dividends are safe for EL stock. Historical PE suggests that it's been trading at high to early 30s of PEs. I don't think it should trade at those PEs. I think it should trade at early to mid-teens of PEs. Well, at least based on their margins. Price to free cash flow, I have an allowable of 20. But look at their average historical price to free cash flow. It's too high. If I use my allowable price to free cash flow here, I'd have an equivalent price of 107.11. Same with the PB ratio. It's too high. It's trading around 9 to 10 PBs. It's expensive, almost twice my allowable PB ratio of 5. If I use 5 here, I'd have an equivalent price of $86.54. Here's more financial metrics. PB ratio is high, 13.74. Current ratio is good for the quarter though, 1.75. The debt level for EL stock is low. Again, this is EL's valuation summary. It's overvalued in our metrics. Let's look at their charts and confirm our entry prices. 94.22 here is my fair values. $80 is 3% dividend yield. 4% dividend yield is $60. 86.54 here is my 5 allowable PB equivalent price. I'd only recommend buying EL stock at $80 so you can have your 3% dividend yield and below 5 PB ratio. This is just severely overvalued, guys, both in my metrics and Guru focuses. You want to know why is that? Is it poised to grow more? What are their expectations for growth for EL stock? Is it a monopoly for them? A duopoly? Do they dominate the space? How much of this is moat multiple? How much is this is growth multiple? Either way, I don't think you should pay for either of those. For EL stock, I'd recommend a sell or just simply put this on your avoid list. You don't have to short, just wait and see how the stock performs. I won't recommend adding to your positions here. If you still own it, ride the bull run, maybe realize some gains left and right. So yeah, for EL stock, $80 for long-term entry.